I'm Alan Kenny, Editorial Director with REIT.com, and I'm in San Francisco for REITWorld 2013. Joining me is Stephen Marks, Managing Director with Fitch Ratings. So Stephen, Fitch Ratings recently released a report looking at how the current market cycle compares to 2007. Can you give us an idea of some of the conclusions that were drawn there?
Sure. Yeah. The big I guess one thing that would be helpful if I start with kind of the genesis of the report, which was we looked at REIT bond spreads relative to corporate REIT bond spreads, and what we found was that 06-07 was when spreads were their tightest, and kind of in mid-013 was right when spreads were nearing similar tight levels. And we wanted to investigate whether or not the overall credit profile of REITs was the same, better, or worse than in 06-07. And the biggest takeaway was what we found is that there's a marked comparison, an improvement in credit quality now relative to 06-07. Really when risk was at its all-time highest in the REIT sector in 06-07, spreads were at their lowest. It seems, in our view, that the credit quality of REITs is now much better on a couple of different fronts. Leverage is lower, development exposure is lower. Companies have the concept of an ATM, an at-the-market equity issuance program, which basically didn't exist 6 or 7 years ago. Companies have just done a better job in mitigating risk, really all across the board. And so in general, we felt like the market had it a little more right this time than they did back 6 or 7 years ago.
Stephen, what does all that say about REITs and their de-risking platforms?
Well, what we think is that the companies have done a good job in de-risking. Credit probably was not at the top of mind of a lot of REIT management teams during the most recent credit cycle or commercial real estate cycle. Companies weren't as focused on leverage. They were mitigating leverage. There was a lot of growth and there was a lot of development exposure. And companies now think about credit a lot differently than they did a while ago. It's much more important understanding that credit or having poor credit quality can hinder companies' access to capital, which can hence hurt their liquidity and their ability to fund their businesses, which is really important, especially in this sector where companies can't retain capital. They need consistent access to capital all the time. Credit is a big part of that, especially in the unsecured market and in the bank term loan market and the bank unsecured market. So the de-risking initiatives are something that companies probably are paying a lot more attention to, and it's just more important generally as they formulate and they think about risk and credit into their overall strategies.
And from a ratings perspective, how do you see the evolution of technology impacting REITs and commercial real estate?
There's not a direct impact, but there is an indirect implication in the sense that what we're finding is that technology is impacting a lot of what REITs do, really almost across every commercial real estate asset class. Whether it's in the apartment sector where companies have fully embraced elements such as a revenue maximization model, previously used in most cases in the lodging industry or the airline industry. So multifamily has embraced technology. In the retail space, that's where there's a little bit more of a risk from technology. Clearly, with the advent of the internet and online shopping, that is eaten into the demand on the margin for retail real estate. And what we're seeing is retailers embracing the omni-channel approach towards interacting with their customers, and so that ultimately, on the margin, that less demand will ultimately filter through down to potentially some over-retailed markets in this country. In office with technology, the working from home, as a for instance, or the concept of electronic law libraries, as opposed to having a law firm have an entire wing of its floor dedicated to having a physical library that's now in the cloud or in some sort of electronic format. So hence, there's just less demand for office space, we feel like, given technology. And then, but on the flip side, an asset class like industrial, where Amazon, for instance, is migrating towards a ship today or deliver today model, which means that there's more demand for industrial real estate, probably closer to some major hubs, as opposed to being out more in the further away from some of the major cities. There's demand more towards being closer to populations and being able to serve your customers more easily by being closer to those larger cities.
All right, well, Stephen, thank you so much for your time.
Yeah, thank you very much, Alan.
And for more on this and other REIT news and analysis, be sure to check out REIT.com.